The second tax trap happens when you hit 70 years old. So the story goes like this. You sign in with a brand new company. They bring you into the HR department, and everybody's highly motivated to help you make the wisest financial decisions that you can. And you want to do that. In fact, I had a phone call just yesterday from a young man, 22 years old. I just started work for a company. The HR department is ready to sign me up. I need some advice on what do I do? And my advice to him was, don't sign up yet. Go build up some emergency reserves. And I think that's probably some good advice to the young guy. I didn't tell him not to save money. I said to build up some after-tax money. And so when you put the money into the 401k, you don't have to pay taxes on it. It comes off of that top line of your income every year, right? So if you made the 60 and you put 10,000 in your 401k, then you're only down to paying tax on 50 if you didn't have any other deductions, and to make this really simple. But when you get to be 70 years old, now it's time to pay the piper. And most people pay the piper, take money out that they really don't need. I've got a lot, and that's part of this patchwork of these conversations I've had as people come in. In fact, the gentleman I referenced before, his required minimum distributions were over $100,000 a year. He had to take it. We went through a very complete financial analysis, and he needed about $30,000 a year above his pension and Social Security. But he had to pay tax on all of the required minimum distribution. Well, all of that required minimum distribution above $100,000 took him to a much higher tax bracket. You see how it links together now? Now all of a sudden he's got to pay taxes on money he doesn't need at a higher tax rate than probably what he put it away at. Because go add $100,000 to anybody's taxable income and it's probably going to raise your rates up. So this illustration shows you that if you started at age 70 with $1 million IRA and you were forced to take out your required minimum distributions, your required minimum distribution at age 70 is a little over $36,000. If that IRA earned 5% a year, the way the required minimum distributions rules work is that every year you get older, you have to take a little bit more out. A little bit higher factor comes out. So the calculation is redone based on every December 31st. And if you're older, you got to take a bigger factor. Well, you'll notice that the required minimum distributions at just a 5% rate of return mean that at age 85, they're pulling out $75,000 that they have to pay taxes on the same principal amount because they went higher and higher. Well, inflation means that you got to spend more money and all those things work out. But most of the people that we work with, we find that when they retire, they don't need anywhere near that amount of money in required minimum distributions by the time they get to be 70 years old. And so then they're forced to pay taxes on money that they don't need, right? So that's part of the trap that I see that's out there that we're talking about.